Investing can be tough, and even experts trying to time the market often miss the best moments. Dollar cost averaging helps by making investments automatic, making it easier to handle uncertain markets, and encouraging regular investing. But how can this strategy benefit your investments? Join us as we explore the concept of dollar cost averaging. Dollar cost averaging is a straightforward method for investors to steadily grow their savings and wealth over time. It works by consistently investing a fixed amount at regular intervals, regardless of how the market is performing. This approach helps investors avoid being overly influenced by short-term market fluctuations. A common example of dollar cost averaging is seen in 401(k) retirement plans, where employees contribute a set percentage of their salary into selected investments. These contributions are automated, occurring with each paycheck. Depending on market conditions, employees may buy more or fewer shares with each contribution, but the focus remains on long-term growth rather than immediate market ups and downs. Beyond retirement accounts like 401(k)s, investors apply dollar cost averaging to other investments such as mutual funds or index funds. This strategy can be used in various types of accounts, including traditional IRAs or taxable brokerage accounts, to systematically build investment portfolios. For those starting out in investing, especially with exchange-traded funds, ETFs, dollar cost averaging is a recommended strategy. Moreover, dividend reinvestment plans also enable investors to use this method by automatically purchasing additional shares at regular intervals. Dollar cost averaging offers several benefits for investors. Firstly, it helps to reduce the average cost of investments over time. By spreading out purchases, you can avoid investing large sums at market highs. This method encourages consistent investing, which is crucial for long-term wealth accumulation. Moreover, dollar cost averaging operates automatically, which eliminates the need to time the market. This approach reduces stress about when to buy, as investments are made at regular intervals regardless of market conditions. It also avoids the risk of buying only when prices are high, as purchases are spread out over time. Additionally, this strategy ensures that you're consistently invested, ready to capitalize on market upswings whenever they occur. By removing emotion from investment decisions, dollar cost averaging helps maintain disciplined and rational investing habits. This approach can potentially enhance portfolio returns by avoiding impulsive decisions driven by market fluctuations. Dollar cost averaging may also help prevent your emotions from undermining your portfolio. When you invest a large sum of money in one go, there's a higher risk of feeling regret if the timing turns out to be bad. This is because people generally tend to be more sensitive to losses than gains, a phenomenon known as loss aversion. Dollar cost averaging mitigates this by spreading your investments over time, reducing the impact of poorly timed decisions on your overall portfolio. Another psychological factor at play is anchoring bias, where investors may hold on to an investment bought at a historical high, believing it should retain its initial value. By using dollar cost averaging, investors avoid fixating on a single purchase price. This approach makes it easier to stick to a predetermined investment plan, allowing for more flexibility in buying and selling decisions. But who should use dollar cost averaging? This investment strategy offers advantages that appeal to various types of investors. It involves regularly investing a fixed amount of money over time, regardless of market conditions. Dollar cost averaging is particularly attractive to novice investors who may not have the experience to predict the best times to enter the market. By spreading investments over regular intervals, they avoid the pressure of timing the market, which can be daunting during volatile periods. This method encourages discipline and consistency in building their portfolio. Moreover, long-term investors find dollar cost averaging beneficial. For those committed to regular investments but lacking the time or interest to closely monitor market fluctuations, this strategy provides a reliable approach. It simplifies the investment process, allowing them to focus on their long-term financial goals rather than short-term market movements. However, dollar cost averaging may not suit every investor. It may not be ideal during periods of steady market trends, where lump sum investing could potentially yield better returns with lower transaction costs. Evaluating the market outlook and considering broader economic factors is essential before committing to this strategy. It's important to note that while dollar cost averaging can lower the average cost per share over time, it also involves higher transaction costs due to repeated investments. Investors should weigh these costs against the potential benefits of spreading risk and maintaining a disciplined investment approach. But the question is, how does dollar cost averaging work? Imagine you have $500 to invest in shares over 5 months. With dollar cost averaging, you invest a fixed amount regularly, regardless of share price fluctuations. Here's how it plays out. In month 1, you invest $100 when shares are $5 each, buying 20 shares. In month 2, another $100 buys another 20 shares at the same price. Month 3 sees a drop in share price to $2, so your $100 now buys 50 shares. In month 4, shares rise to $4, purchasing 25 shares. And in month 5, back to $5 per share, buying another 20 shares. Despite the varying share prices, your strategy results in an average cost per share of $3.70. In total, you've acquired 135 shares for your $500 investment. Compare this to not using dollar cost averaging. If you had invested the entire $500 in month 1 at $5 per share, you would have only acquired 100 shares at an average cost of $5 each. The advantage of dollar cost averaging lies in its ability to capitalize on price fluctuations. It spreads your investment over time, reducing the impact of market volatility. For instance, buying more shares when prices are lower, like in month 3 at $2 per share, lowers your average cost per share. In a perfect scenario, investing all your money at the lowest price point, month 3 at $2 per share, would yield the most shares, 250 in this case. However, predicting the best time to invest is nearly impossible. Dollar cost averaging mitigates this uncertainty by spreading investments across multiple periods. This strategy is particularly valuable in volatile markets. It helps avoid the risk of investing a large sum at a market peak, potentially resulting in fewer shares acquired at higher prices. Instead, by consistently investing fixed amounts over time, you increase the likelihood of benefiting from market downturns when share prices are lower. However, it's important to understand its limitations. If the price of the investment keeps going up, investors using dollar cost averaging will purchase fewer shares over time. On the other hand, if the price consistently drops, they might keep buying when it might be wiser to hold off. This strategy doesn't shield investors from the risk of falling market prices. It assumes that, over time, market prices will increase, aligning with the viewpoint of many long-term investors. Using dollar cost averaging for buying individual stocks without thorough research can be risky. Investors might end up buying more stocks continuously, even when it might be prudent to stop or sell. For less experienced investors, dollar cost averaging is generally safer when applied to index funds rather than individual stocks. One of the benefits of dollar cost averaging is that it can lower the average cost of an investment over time. This can reduce losses on investments that decrease in value and enhance gains on those that appreciate. Ultimately, dollar cost averaging offers a disciplined approach to investing, emphasizing consistency and long-term gains over attempting to time the market perfectly. How do you currently manage your investment strategy? Are you considering implementing dollar cost averaging to reduce emotional decisions in your portfolio? Share your thoughts in the comments below, and don't forget to like, share, and subscribe for more insightful content on financial planning and investment strategies.